My name is Anette Jönsson. I'm an associate editor at Dealreporter, where we cover primarily event-driven and special situations. We also have a separate team that focuses on ECM. If you're not familiar with Dealreporter, you may be aware of some of the other products that are within our parent group, Accurus, such as Merger Market, Debtwire, PAR, or ABCJ. We are going to be talking here about the M&A in a world of heightened deal break risk. It has certainly been an interesting few months in M&A, with gloomy headlines of spreading viruses, economic collapse, widening spreads, and indeed deals breaking. But here in Asia, we have also seen new definitive and indicative deals being announced in Japan, Hong Kong, Taiwan, India, and most recently Australia. We've also seen one or even maybe two auctions proceeding at a slow pace, and we've seen Chinese antitrust approvals being granted for at least 3 significant global transactions. So things are not altogether gloomy. To shed some light on the current environment, as well as the risks and potential opportunities going forward, I have 4 panelists with me here. We have Clara Law, a Delta One strategist at Societe Generale, Nikhil Sudheer, an associate in investment banking based in London, Frank Troise, who's regional CEO of SenaHill Partners, and Felicia Ling, an M&A banker with DBS. I'm going to give them each 30 seconds to introduce themselves. We'll give everyone a chance to make sure their mics work, and very briefly about how they fit into this discussion. So we will start with Clara.
Hi, good afternoon, everyone. This is Clara. I'm the Delta One strategist in Societe Generale, as Annette mentioned. So my focus is providing market intelligence in the Delta One space with a focus in corporate actions and event-driven trading strategies. So I've been in similar capacity in the past 10 plus years at different banks. So I think in today's panel, I'll be providing views on the M&A space from the public side, and obviously in the listed space as well, particularly looking at trading strategies around the announced deals and trying to preempt the upcoming deals in Asia.
Thank you, Clara.
Thank you.
Nikhil?
Hi there, thank you, Annette. So I'm Nikhil. I work as an associate investment banker at a bulge bracket investment bank based in London. I primarily cover emerging markets, which include the Middle East, Turkey, South Asia, Russia, and a bit of Central Eastern Europe. Again, primarily focusing on cross-border M&A and also, domestic deals. So in this panel, my contribution would be primarily towards the mitigants that buyers and sellers use to navigate this current scenario.
Great, thank you, Nikhil. Frank?
Thank you, Annette. My name is Frank Troise. I'm the regional CEO and managing director for SenaHill Partners. Our firm is the only local U.S. institutional investor ranked fintech firm here in the region in Singapore, and we're very excited to be here today.
Thank you. And Felicia? Felicia, you are on mute. Let me see.
Hi.
Thanks.
Yeah, this is Felicia. I am a vice president with DBS Bank. I work in the healthcare and pharmaceuticals team under the institutional banking group. So my experience has largely been in the origination side of wholesale banking. So I support my clients in a range of banking requirements, from M&A, private and public fundraising, all the way down to their day-to-day cash and trade requirements. So I think in today's discussion, my contribution would probably be more on the area of M&A financing, and also how corporates are looking at M&A opportunities in these recent times. Yeah.
Okay, great. All right, so let's kick off then. We'll start with Nikhil. What has been the key concern and the focus for offerers and targets of already announced situations once this whole COVID-19 and market collapse started to take hold as of early March?
Thank you, Annette. I think in this environment, this is a question more for buyers than sellers. Sellers tend to be keen to push the deals to closing, as pre-COVID-19 valuation would be a favorable outcome in these times. For buyers, some of their pressing issues will include, first of all, valuation. How do they reassess the fair value of the asset, both in terms of certainty of cash flows and your cost of capital? Buyers will be keen to conduct an unusually detailed interim DD process from signing to closing, to understand the various levels at which COVID-19 has impacted the business, starting from demand, supply, raw material procurement, manufacturing, supply chain capabilities, working capital requirements, and the list is endless. So I think this particular phase from signing to closing will be unusually long, especially given that management would not be easily available for one-on-one meetings. So we are looking at a delayed sort of timeline from signing to closing for buyers to reassess the fair value of the asset and think if this is something they should be pushing towards closing. Now, having said that, obviously, the second most important aspect would be your reps and warranties, which sellers sort of guarantee at the time of signing. Now, some of the reps and warranties offered by the seller at signing might not be adhered to over the course of this disruptive cycle, and buyers, would be using this time from signing to closing to work closely with legal counsel and investment banks to understand their termination rights and the indemnification compensation that they would be entitled to.
Right.
And I think a couple of there's other aspects as well. I think we'll get to that towards the later part of this panel. Is you see your MAC and MA clauses. Now, this is probably the most popular SPA clause that's talked about. And we can get to that later, but that would be an interesting topic of conversation between buyers and sellers. And finally, it's this whole restructuring of your valuation, right? So considering a deferred compensation or earnouts as part of the renegotiated purchase price package, I think will also come into play, only to share the risk between the buyer and the seller if both of them want to push the deal to closing. And finally, it's the regulatory delays which one should expect in this environment, especially authorities like antitrust, competition authorities, CFIUS, etc. There's going to be delay in their outcomes. I think these are probably 4 to 5 important themes that buyers and sellers will be looking at in these times.
Indeed, it has been occupying a lot of people's minds. What about financing? Felicia, you have some insight into what's happening in the financing market. What's the current situation, and how are buyers and sellers approaching it?
I think in terms of new deals, it's definitely slowed down, and one of the key reasons being the M&A pipeline has also slowed significantly with the developments of the coronavirus. And the other aspect to it is that the widespread impact of the COVID-19 across all industries, and I cover healthcare. The healthcare industries, and this is considered a very highly defensive industry, and yet when we're speaking to our clients, we are seeing month-to-month revenue declines in the range of 50 to 70%. Companies at EBITDA break-even or even EBITDA negative levels. So naturally, this affects the cash flow profile, and where banks and lenders are concerned, it would translate to probably a lower debt financing threshold. Yeah. I think the interesting, the grayer area is what about those existing deals which have been committed but yet not drawn because the acquisitions have not come to a financial close. We are fortunately, I guess, not seeing banks triggering MAC clause as a means to pull out of transactions at this point in time. And I think a very key aspect to this is that in terms of the LBO and the acquisition financing market, it has increased significantly in both breadth and depth since it was being introduced into Asia 20 to 30 years ago. I think during those times, we were looking at this as almost an exclusive playing field for the investment banks or the leverage finance houses. But over the years, we see that the regional banks are increasingly becoming playing a more important role in M&A and acquisition financings. And today, if I were a buyer, prospective buyer, and I would like to arrange a financing for an acquisition, the first group of banks that I would reach out to is probably their existing relationship banks. Reason being, they are the ones who understand the credit the best, and hence they can give you the sharpest pricing and the probably the more favorable terms. Now, coming back to this deal break risk in this environment, right? I think what this translates into is that when you have relationship banks in transactions, they take a very different lens when they look at the deals. So one, they understand the client, they tend to understand the clients better, and hence the likelihood of them having a knee-jerk reaction and withdrawing lines just because there is a sudden shock in the system tends to be lower. And at the same time, we also cannot forget that as relationship banks, these are probably client relationships that they have been cultivating for like 10, 20 years. I know of some clients which have been with the banks for 3 generations. So are they ready to just jeopardize this relationship that they have spent so much time building just for something that's potentially transitory? So I think for these reasons, the financing market has remained relatively stable so far.
But even so, we keep hearing about deals that have been in discussion since November, December, January, and where financing is still in the works of being put together. And these buyers are struggling to get banks to commit. How do you view that? I mean, you're sort of suggesting that it's in these banks' interest to provide financing, but for the long term, but yet we're seeing multiple occasions of deals struggling to get financing in place.
I think given the market conditions and the fact that liquidity is tightening, banks that generally make new deals, I think this would fall within the category of new deals, where banks tend to want to err on the safe side because there is a lot of uncertainty as to when this coronavirus situation is going to end and how long this impact in terms of like negative poorer cash flow is going to be. So when new deals are concerned, yes, I tend to also agree that the climate is a little bit more cautious. But where existing deals are concerned, meaning to say loans that have already been committed but not drawn yet, so that is where there is still some relative stability. We're not seeing banks pull out from those yet.
Okay, thank you. Clara, I wanted to ask you about how event-driven investors have been responding to this situation and how they are positioned now as we are perhaps coming out of the most acute crisis here in Asia, at least.
Yeah, so I'm looking at the announced deals in Asia during this period of time. Obviously, since February until March, until now, we have seen spread widening. We have seen the widening to happen in phases. In the first 2-3 weeks, the spreads have been pretty resilient, meaning that it's still pretty tight, trading at pretty tight levels. However, starting in March, we have seen the spreads widening very significantly as the market bottomed out. This is obviously driven by the increase of risk in the announced deals, the potential termination, and also the delay in deal progresses. But more importantly, we have seen investors' existing positions were being stopped out because of the market volatility and market movements. So meaning that because the mark-to-market losses are quite large, so that they have to start up from some of the positions they're holding, even though the deals that we're thinking that it should be highly probable to succeed. Some examples we can see in deals in Singapore, for example, the Capital Mall Trust deal, the Fraser. We have seen the spread widen from parity to around mid-single digits, say 5%. Similar things happens in Japan and in Hong Kong as well. So after the market bottomed out in March, we have seen the spreads to rebound, just like to narrow, just like how the market rebounded in a V shape. currently the spreads, a lot of the spreads are trading at pre-crisis levels. Obviously, for those that involves a delay, a potential delay in the deal completion, and also the regulatory approvals, those deals are still trading in wider spreads as compared to the pre-crisis levels.
Are investors seeing the recent volatility as an opportunity, or have they generally become more risk averse and choosing to stay away?
Yeah, so when we see the deal spread become really wide during early March, a lot of investors are basically busy handling their current positions. As I said, they're being forced out in some of the positions, so they're very busy in handling the risk involved. After dealing with that, we have seen a lot of them have taken on risk, and as you said, the opportunities arise when the deal spread widened. We have seen that they put on risk in those spreads. However, the size of the investments are not as large as before, so they're taking a kind of opportunistic moves. And also, interestingly, there are some deals that have been completed during this period of time. Heading into the deal completion in the last week, we have seen a lot of investors are piling in the investment into those deals because obviously they're risk-free and they're trying to maximize their profit. So running into the very last few days of the deal, we've seen the spread narrowed very significantly into like 10 to 20 bips. So I would say that they're building up, they're taking the opportunities that arise, but not in a very aggressive levels if the deals are still with the risk.
No one is saying no to risk-free returns, however small, these days. Is that right?
Definitely.
Yeah. Frank, good to see you still with us there. Wanted to ask you a little bit about the deal pipeline. What are we seeing at the moment in terms of new deals, and what needs to happen for the deal flow to pick up to get to more normalized levels again?
That's a great question, and I think there's a few ways to think about it relative to how everybody has framed the discussion today. On our end, if you asked me that question as soon as 6 weeks ago, I would have had a different answer to it. Our firm, to oversimplify it, a majority of our activity just 2 months ago was focused on raising capital. Now that's shifted, where a very, very large proportion of our business right now is focused on M&A. And candidly, this is the busiest time we've ever had, period, in the history of our firm globally. If you look at any of our offices in Europe, the States, and now here. With that, what we are seeing is, because of COVID, the hard pragmatic realization on the behalf of our clients, where they realize they have no visibility regardless of the strength of the company. They have no view into the capital markets the next 6 to 12 months in terms of their comfort level to raise any more additional funding. Regrettably, the comparison they'll use in the market is they'll use SoftBank and WeWork as an example of how all of this can go wrong very, very quickly. That aside, what we are seeing is a clear bifurcation where we're seeing US firms now recognizing that the US markets have completely slowed down, either to a recession or depression, depending upon which view you want to take. And they're now coming to Asia. So a predominant portion of our activity in terms of our pipeline is now US firms looking for partners, acquirers, and also acquisitions here in region, similar to some of the announcements we've seen from some of the better known US unicorns and decacorns. So we actually see an extraordinary step up, and we see it in areas where there's been a predominant part of overinvestment. So we have, in terms of our focus on fintech, we're now seeing that there's going to be a massive consolidation underway, and we're anticipating that'll be there for the next 12 to 24 months at a minimum. And candidly, we've gone so far as to say we believe going forward that this will probably ode the beginning of the end of fintech as we knew it, because now this consolidation will occur and there'll be this migration of this IP to larger companies and larger incumbents. Beyond that, 12 to 18 months out, it's very, very difficult for us to say, but we have, as I said, this is the busiest we've ever been, period, in the history of our firm.
Interesting. Without repeating any of that, Nikhil, are you seeing any other things that needs to come into place for deals to pick up again?
But I think in terms of the signed deals being pushed to closing, I think targets can ensure regular disclosure during the period to reduce the indemnification liability should the buyer wish to exercise termination on the basis of bring down reps and warranties. And also agreeing to an earn-out structure may also be key here, because most of the discussions will be around how to share the risk between the buyer and the seller. And I think another aspect is that some buyers might now struggle to deliver on their financing package, in which case sellers can claim a reverse breakup fee from buyers should the deal get to a point of renegotiation.
Yeah, you mentioned earnout. Are you seeing a lot of deals being renegotiated to include earnouts?
Well, there are situations where these are being considered, but again, these are really transitory times, so we don't really know if this is being pushed to that sort of agreement. But it's definitely on the table.
Okay. I wanted to go back to what was mentioned earlier about MAC clauses. There has been a lot of questions about this over the past couple of months. Investors have been panicking a bit about whether these are going to be used for buyers to walk away. Here in Asia, we've seen at least two situations where. One in New Zealand, where the buyer EQT was invoking a MAC to terminate a deal with MetLife Care, and one in Australia for a significantly smaller situation called CML, where Scottish Pacific was looking to invoke a MAC to walk away. Now, the approach from the targets were very different in these two situations. In terms of CML, they negotiated a mutual termination of the deal with Scottish Pacific, while MetLife Care is taking EQT to court over the invocation of the MAC clause in that situation, because they're not agreeing with it. Now, how should we look at the relevance of MAC clauses in a COVID-19 environment, and how can they be used, and are they something to be worried and scared about as an investor? Shall I start with Felicia, perhaps?
Well, when I started in banking about 10 years ago, I was always told that, the MAC clause is always there, but, nobody actually uses it. So these are definitely unprecedented times, both in the banking market and in the M&A market. So I think it is very in line with what Nikhil has mentioned, right? Where valuations have become an issue. Definitely there is this divide which is causing some potential buyers to think whether or not they want to walk away, whether or not the business model has significantly deviated from what they thought it was when they signed the deal. So I believe that I do still believe that at the end of the day, it is more likely that they would move towards settling on a walkaway fee, because ultimately, if you speak to most legal counsels, they would tell you that a MAC clause is very difficult to prove, and it would be a very costly and a long-drawn battle in court, which I think is not beneficial for either buyer or seller.
Okay. Frank, I have a question from the audience here, an anonymous attendee that relates to this. This person is asking, do you believe a company should exercise its discretion in backing out of a deal, seeing as how many of them are cash strapped because of the pandemic?
Well, regrettably, I've had the misfortune of going through the GFC and seeing similar behavior. I mean, let's just face it, at a base case level, this is another tool in the arsenal that you can use. And the reality here is you're buying the optionality of time, to the degree that you utilize this. So in this environment, if we were advising a client and they had the ability to A, get better terms on a deal and or extend time and have better visibility, absolutely, you would do that. And again, this is the same thing we saw during the GFC, where firms had so much uncertainty regarding the condition of the financial markets that it really was a function of just buying time to do that. And right now it behooves, and you can almost make the argument as well, it almost behooves them at a fiduciary level. If they can get a better deal at the end of the day, then they should. And if this is an option to utilize, then they should use it.
Clara, you look at this a little bit more from an investor point of view. What's your view on this? Is this something that investors should be a bit scared about, the prevalence of these clauses?
Yeah, similar to what Felicia mentioned just now, we've always been told that the MAC clauses are just there, but no one really pay attention to it. But obviously in the past 2 months, the most frequent question that I've received is what are the MAC clauses and what would that be triggered? I think going forward, this will obviously let investors pay more attention to the MAC clause. And we found out that in a lot of documents, actually the clauses are written in a way that they are pretty vague. So I think going forward, a lot of these clauses could be written in a more explicit way, and probably also switch from a more seller-friendly clause to a more buyer-friendly one, so that you know, it would be protecting from the buyer's perspective. And on that front, if they're more stated more explicitly, investors will be more comfortable in investing in those deals as well.
Yeah. Do you see? Do you expect there to be MAC clauses playing a bigger role in deal agreements going forward?
Yes, definitely. I see that will be a bigger place in the future. Definitely true if this pandemic is to extend for a more prolonged period of time, because we have seen ongoing deals. Actually, for example, the long stop date could be the end of 2020. So there are still chances for the clause to be invoked. So that's why I think that it would definitely play a much more important space in the future.
Nikhil, you're nodding a yes there. Are you advising clients, or are you discussing the involvement of these clauses with your clients who are looking at doing deals going forward at this point in time?
Indeed, I mean, there are situations where we are, of course, at how we could, help buyers and sellers use MAC clauses to their benefit. Now, the interesting point, as Felicia mentioned here, is MAC clauses are typically drafted so that the effect on the target industry will not trigger a MAC without an evident impact on the target sector. So let's say the sector in general has gone down and so has a target that might not necessarily trigger a MAC. So it should really be it should be an impact on the company or the target per se, as opposed to the sector, which makes it very, very challenging to pull off towards the benefit of the buyer or a seller. And it's really the court's discretion to basically give the outcome in favor of each party. So I think the MAC is, in most cases, as Clara mentioned, it's used as a leverage for renegotiating terms rather than a way out. So and that's pretty much where, like from like my experience, that's what MAC clauses have been discussed for.
Great, thank you. I've gotten a permission here from the powers above that we can go on for a couple more minutes. I wanted to ask about opportunistic deals. I mentioned at the beginning, and some of you have echoed that we have seen some deals being agreed during this period over the past couple of months. In Hong Kong, in particular, we have seen some take-private situations where perhaps the controlling shareholders have taken the opportunity to make use of low valuations to take their listed companies private. in terms of opportunistic deals, Frank, if I direct this to you, how receptive are company boards and long-term shareholders likely to be to these opportunistic offers who may come at a very low share price?
That's an excellent question. I think in a nutshell, we're finding now that again we've lost certainty regarding any visibility in terms of the public markets. We've lost visibility in terms of financing in the private markets, and now what we would categorize as, in the old days we would refer to these as moonshot deals. We're now finding that boards are much more receptive to thinking a lot more, I don't want to say opportunistically as much as I would use the expression creatively, in terms of structure, in terms of counterparts. We've also seen one transaction that we highlighted in the States was with a client of ours called Motif, which was acquired by Schwab, where Schwab completed a transaction in 2 weeks that normally would have taken them 9 to 12 months to get done. So again, and this was a company where Motif just 2 weeks prior had announced that they were completely shutting down. And Schwab had managed 2 weeks after the fact to come in and accelerate a transaction to that point. So I think you're right. I think opportunism is going to be crucial, creativity, thinking out of the box, and kind of throwing away the rule book as it relates to time to execution.
We here in Asia, we've seen them mostly in Hong Kong, I would say. What would it take to see similar deals in other markets?
Is that for the group or
Frank?
myself?
Yeah, Frank, would you continue?
Without opening the kimono too wide, we're definitely seeing the same type of discussions occurring here now, where companies where politically, strategically, competitively would have never had a conversation with one another are now doing that. We're also noticing some very, very interesting, what I've categorized as crossing the vertical, where companies where you would normally never think they would work together are now finding commonality regarding data, customer segments, geographies, licenses, or just pure cash flow, where companies now are recognizing they can take more of a holdco mindset relative to what they need to do to get through this. We're also noticing a lot where politically we're seeing Western firms much more amicable to doing deals with Asian firms and vice versa, where 6 to 12 months ago this would have been unheard of in this market. So COVID's actually created a lot of creativity in this market as a consequence.
Felicia, if I check in with you, what does offerers need to do to make sure that an opportunistic deal gets done, that it's successful?
Perhaps because I'm seeing it more from an inside-out perspective, because I interact more with the corporates, right? So on my side, I'm not actually seeing a lot of these so-called opportunistic transactions, because most of the deals that are coming out and are being announced have actually already been in discussions for a very, very long time. Yeah, and I mean, just to give an example, one of the deals that I started working on sometime in like 2010, there were two can manufacturing companies which finally came to a closure in terms of the M&A in Malaysia. That took 9 years before the deal actually closed. So I think at the end of the day, it is really still down to the fundamentals, whether or not the asset is something where, from the buyer's perspective, and often if these are strategics, is there an underlying growth story for it? Whether they are undervalued even before this acquisition, the current COVID situation, and also if whether leverage is low enough for them to take on financing to drive the returns. Now, I think what the COVID situation has done is that it has provided a catalyst for these discussions to be accelerated. So, and this is probably why we are seeing more deals surfacing at this point in time as compared to before.
Right, thank you. Clara, just want to check with you as well. How do you see investors approaching this in terms of where are the opportunities at the moment? Are there opportunities in these opportunistic deals, or are they perhaps a little bit too risky for investors to get into at this point in time?
I think for the new deals announced, whether it's been opportunistic or not, is really dependent on obviously the offer price and the conditions of the deal as usual. This is as usual. We have seen a lot of, not a lot, but we have seen coming up a lot of majority shareholders maybe launching opportunistic deals. And on the other hand, we are also starting to see some more activists are getting more involved in launching the deals and maybe pushing the corporates to do something about restructuring the company. So I think all of these opportunities investors to invest in, and I don't think in particular that the COVID situation will increase more risk towards investing in these deal spreads, because all it matters is the offer price and also what are the conditions stated out. If everything is clear, then I think the investors are comfortable to invest in those spreads.
We have one question from the audience here that relates to that. Someone is asking, is there a risk that some investors get too greedy at this moment and hurt themselves in the long run?
At this point of time, I don't, as I mentioned previously as well, I don't see a lot of investors putting on a lot of risk or a massive overwhelming amount of risk. They're quite opportunistic in the deals that they selected and the size that they invest in.
I have a final question here from the floor as well, as it were. Nikhil, I think, might be a good person to answer this, since it relates to emerging markets. Due to the ongoing China-centric political tension in the Western world, are manufacturing firms in emerging economies such as India, Indonesia, etc., poised for takeovers from Western firms due to outsourcing concerns?
Well, I mean, this is definitely definitely one of the mega trends that we see in the world today. Especially, we've seen recently that India is opening up its market to the Western world to capture some of the manufacturing gap that might come as a result of the broader geopolitics that's shaping up. Again, this is, we will have to wait and see. But definitely it also depends on how these geographies adjust to the pandemic, right? So for example, in India, we see that the cases are still on the rise, and government's priorities is currently not to focus on FDI and encouraging foreign capital, rather to mitigate the whole crisis that's happening. So I think it's a matter of time, and also how China reacts to the whole situation. We've seen that China has come out claiming that the vaccine that they will be developing will be shared on a global basis, and it's geopolitics is going to be critical next few months, and see how it plays. US-China relationship continues to be one of the key factors that will determine deal flow. So I think these are times that we have to wait and see what happens.
I think this is a discussion that we could continue for quite some time. There's a lot of interesting questions to be talked about. Unfortunately, we're out of time. I'd like to thank the panel and for participating. Thank you all very much. And I would like to hand over to Amanda for a few closing comments.
Thank you, Annette.
Thank you, Annette.